Okay. Okay, everyone. Good afternoon. This is Mark Young, and I'm pleased to have a returning speaker in the form of Randy Cohen, the Harvard Business School instructor, who, just as a reminder, teaches what was my favorite class at Harvard Business School. I just have to put that plug in there. But just an incredible person with many, many keen insights. He teaches investment management plus other subjects at the business school. And we're very fortunate to have Randy today. I did want to just briefly touch on what we'll cover today. And there's really a major umbrella subject, which is, I'll call it the looming debt crisis in the US. And at the moment, the headline risk is about the debt ceiling in the US and will we increase it? Will we default on our debt? I can promise you, everybody in the market is expecting that this will get sorted out before we default on our debt. So that being said, there's 99% of the world is leaning one way. So if we do have an outcome that does not solve the debt ceiling problem, it's going to get real ugly really fast. So we're going to touch on that a little bit, not as, fear mongers, but just to keep the risk in perspective and what to do if this should result, and it's not pretty. But we'll talk about the debt ceiling / debt crisis. And then secondly, I want to touch on the Silicon Valley Bank failure, what that means to venture sponsored businesses, which, by the way, Silicon Valley Bank had 80% market share on venture debt financings. So it's left a gaping hole in the market that people are trying to fill, but there's still a gaping hole. And equally importantly, it's had a knock-on effect on regional banks that now have seen dramatic withdrawals of their deposits, i.e. running the bank, and money moving to the big money center banks that are considered too big to fail. So we'll touch on that. And then lastly, we'll touch on a new initiative from Bridgepoint Capital. And I'll just say we're being reactive and proactive because we have two inbound inquiries that we're working on presently to supply debt financing to a large family office and a growth investor that traditionally would have gone to a Silicon Valley bank. So we're fortunate, having been in the capital markets for a good portion of our careers, we have tremendous networks that we're happy to share and talk about as a final item. And then lastly, Randy and I like to be a little provocative, so we're going to talk about, if we have time, I'll let Randy announce it when we get to that point, but there'll be sort of an all other category that I think is pretty exciting. So that is what we're covering. And I'd love Randy, for those that have not been on our podcast before, to just firstly, if you'd be so kind, Randy, tell us a little bit about yourself.
Sure. Thanks, Mark, and thanks everybody for listening. My name's Randy Cohen. I am a professor at Harvard Business School, a few weeks away from my 25th anniversary of finishing my PhD and starting as a professor. I spent a few years in the middle over at MIT Sloan. Other than that, the whole time at Harvard Business School, and taught a bunch of different courses over the years. But as Mark says, mostly I've taught the investment management course. I have an online course called Alternative Investments, which if people are interested in learning about alts, is a great way to do it. Pretty efficient way of learning. I work together with two brilliant colleagues, Victoria Ibashina and Arthur Siegel. I think that course is great. And then I teach a course called Field X, which is a course where we have about 100 teams a year of startup businesses, which we help them launch and grow, and some really amazing ones that I'm still working with. The class is over, but I'm still working with a bunch of those teams because they're just so awesome. And then, other than that, I work with Bridgepoint and do a bunch of other things in investing. I've helped create a concept called liquid private equity for people who, for one reason or another, need an asset that performs like private equity but stays liquid. So I help create that. And put a lot of energy into that, and also interested in small business finance and other topics. I write about pro basketball in my free time. I have a podcast about blindness called Dangerous Vision because I'm blind, and sit on the board of the Mass Association for the Blind, and help launch a venture capital fund that just invests in blindness therapies. So do a lot of different things, and it's great to be on with Mark and get to talk about whatever the most interesting things are happening in the world today, which I guess right now is the debt ceiling, right, Mark?
Well, Randy, first question, how did you invent a 30-hour day? Because what you just described, for most
I,
people, 99% of the world would be a 30-hour day. I don't
I,
know how you,
I, I have a secret, and my secret is I don't like to be in charge of things. And so, like Mark, you are a great leader, and that's why I love to do a podcast with you because you lead the podcast, and I love to work with you in business because you hear 100 big ideas and you sort down and you prioritize and you organize, and then you call me and you say, Randy, I need you for this, and then I can focus on the thing I'm good at. And in all the businesses I work with, I work with great leaders who direct me in good directions and let me do my thing. But if you said to me, "Hey, Randy, here are the 50 things Bridgepoint's got on its plate. Why don't you figure out what needs to be done first?" Believe me, all hell would break loose by nap time. So appreciate getting to work with you. My co-founder Jean-Louis on the liquid private equity, my friend Adam on small business funding. These folks really carry who I do family office management with. All those people make it work for me. And my advice is any young people listening, probably not too many, but if there's any, figure out where your job is to add value in the world, right? And if you're a leader, be a great leader. And if you're not a leader, you don't have to run things. You can have a fantastic life doing amazing work, making plenty of money, and not be a leader. But figure out where you fit in.
well, that was more than I bargained for, but that's sage advice again. So thank you. The pearls of wisdom that come out of your mouth are just incredible. So thank you for that. So Randy, talk to us about what's happening between Congress and the president on this debt ceiling. And again, 99.9% of the world thinks the deal is going to get cut, but talk about what's happening and what, God forbid, would happen if the negative outcome occurs.
Yeah, and look, probably folks know most of this. We're really the only country in the world that has this up. I think there's a couple other countries, Denmark or something, has a debt ceiling in some sense, but we're the only country that does this thing. In other words, you have Congress votes to spend 5 trillion, and revenues they know will be 4 trillion, and so there's a trillion short, and they say, okay, we'll borrow. Obviously, you're going to need to borrow 1 trillion to make the numbers add up. But then, and so that's fine. That's the budget process, and that is a well understood process, and it's got its issues, but it works pretty well. But then there's this sort of wacky law off to the side that says, oh, but by the way, if you're going to borrow that $1 trillion, Congress has to authorize the borrowing. And you sort of think to yourself, well, didn't they inherently authorize the borrowing by saying we're going to spend 5 and borrow 4, or spend 50 and borrow 40? Spend 5 while only bringing in 4, or spend 50 while only bringing in 48, or whatever the numbers are. And the answer is, well, that's how every other country thinks of it: is you borrow whatever you need to borrow to make the numbers add up. But the United States has this thing that goes back hundreds of years that says no, you have to separately authorize the right to borrow the money. And so this creates the potential for crisis whenever we get close to the cap. And what's happened so basically about 70 times over the years, Congress just lifted the debt ceiling when we got close to the cap. But during the Obama administration in 2011, the Republicans saw an opportunity to push Obama for concessions on things that were important to them by saying, we will refuse to raise the debt ceiling, and then there's going to be a debt default, and it's going to be an economic disaster, and you'll get blamed, President Obama. And then when you run in 2012, you're going to be dealing with this horrible economic crisis, and you'll lose your job. And what many advisors said is that Obama should have simply said, I will not negotiate over this. There's no discussion to be had. You have to raise the debt ceiling. You've done it for every president before, and we just have to do this. We can't let the economy and essentially, play the game of chicken, you might say. But Obama didn't do that, and maybe it was because he was out machoed. But I think what a lot of people believe is Obama wanted to make a deal. He wanted to cut Social Security and Medicare as part of a deal that would also raise taxes, cut other spending programs, and so forth. And he knew that he couldn't come out with a plan that said, I, Barack Obama, want to cut Social Security and Medicare, because that would have been against his brand, would have angered his base, and so forth. But instead, if he could say, hey, we're in a desperate, dire situation, we had to make a deal, and this was the sacrifice we had to make, that he could get it all done. So what happened is he made a deal with the Republican leader, John Boehner, Speaker of the House, and then Boehner's caucus refused to honor his deal. And so then it really was kind of a scary mess, and they ended up coming up with a compromise called the sequester, where essentially Democrats agreed to cut in domestic spending, and Republicans agreed to military spending cuts. Neither side liked the cuts, and something like a year and a half later, they just unraveled the whole thing and just said, "Okay, forget that ever happened." So it was kind of a big mess, leading to nothing that mattered very much. So then we had President Trump, of course. So the Democrats certainly don't do this to the Republicans, and the Republicans, of course, are happy to raise the debt ceiling when the Republicans are president. So it hasn't come up again until now. And now is the moment when the GOP has said to Biden, okay, we're going to let things collapse. And what's so tricky is they have the same problem as before, but even more extreme. In that Kevin McCarthy is Speaker of the House by sufferance of the members of what people sometimes call the MAGA caucus or the Freedom Caucus or whatever. And so a group of members with with very, very strong views on some things, and these are people like Matt Gaetz and Marjorie Taylor Greene and Lauren Boebert and so forth. And so those folks are basically saying, look, we will take away your speakership if you make a deal that we don't accept. So now you have a tricky situation where Biden would like, what Biden thinks is that they should just raise the debt ceiling and then let's go negotiate a budget. And that's what he said is the only thing he'll do. He said, I won't negotiate over this. But now as we get close to the deadline, it seems like he is negotiating. Of course, what he's saying is, I'm really just negotiating the budget deal. But everybody kind of knows that he's negotiating for a debt ceiling increase where he may make concessions. And then when they go into the budget negotiation, he'll have to make more concessions. So Democrats are not happy about this situation. But it is what it is. People understand that Biden is likely to get blamed if there is an economic catastrophe due to a default. So Biden's trying to get a deal done. Or is he? Because there is a skeptical view that says Biden isn't really trying to get a deal done. It's just Biden knows there isn't going to be a deal. He knows that there's whatever McCarthy agrees to, the extremists in his caucus are going to turn down. So what's important, some people argue, for Biden is that he be seen as the reasonable guy who's willing to cut a deal, and that it's those darned Republicans who won't make a deal. Okay. And so that is a possibility. So these things are hard to read. There are even people who go a step further and say what Biden would like is for there to be a default that doesn't last all that long and that gets fixed. But then if a recession hits, which, most experts say is about 40% likely that we'll have a recession over the next year, then Biden can say it's because those Republicans forced a debt default. Don't blame me. Of course, many people will blame him. He's the president, but it's all about shaving a 1/10 of a percent here, a 1/10 of a percent there in electoral politics these days. Everything's so close. So people say that could be part of it too. Okay, let's ask a question. What do the financial markets think in terms of how likely a default is going to be and how bad it would be? Okay, because as Mark says, there's all these people around the world who think, oh my God, this is terrible. And it seems like Americans are just kind of going about their day as if everything's fine. Right? So is everything fine? Well, here's the central thing to recognize. And I got to say, this is not as widely talked about in articles on this subject as it should be. So there was a court decision in the late 70s that said, if the United States government defaults on its debt, it does not have to pay additional interest. So let's just imagine you held a 10-year treasury and you got your coupon payments, and now it's about to come due. And on the last day, you're owed $1 million, right? And let's say that day is, June 15th. Okay. And so on June 15th, you're owed $1 million. And then what happens is there's a debt default in place and they don't pay you. And then let's say they pay you 10 days later, right? Well, the question is, do they owe you $1 million plus 10 days worth of interest? And what this court decision said is they don't. They just owe you the $1 million. And that's kind of unfortunate, I have to say, because if the court decision said, yeah, if there's a default, no biggie, we'll pay you later and we'll make up the interest difference. Well, there might be arguments about exactly what interest rate to use or whatever, but we kind of get it. And I think that would enable people to be pretty mellow about the whole situation. Not completely mellow, nor should they be completely mellow, but moderately mellow, if you like, a modified limited mellow for those who remember Watergate. So, but that's not what the court said. The court said, hey, there's no extra interest owed. All you were promised was the coupon and the principal. If the principal comes late, that's on you. Okay. So what that means is that people do need to worry that if their payments are delayed by a week or a month or a year, they are actually losing out in a big way because they're not getting interest. But it also is sort of convenient in that it enables us to estimate how likely the market thinks a default is, right? Because we have bills and bonds that are due at the end of June or the middle of beginning of June or the middle of June or whatever. And we can look at those prices and say, how much extra are you getting paid? In other words, suppose that the short-term interest rate is, whatever, 4%, 5%. Let's say it's 5%. And you had a bill with a tenth of a year to go. If you knew it would get paid, then that would be around 99 and a half, right? Because 5% divided by 10 is a half a percent. And so you'd say, okay, they owe you 0.5% of interest. So it would sell for about 99 and a half, settling to 100. So if you look and see that that doesn't trade for 99 and a half, it trades for 98 and a half. Well, then what that says is, gosh, the market thinks that you're going to have to wait extra time to get paid. I don't think the market thinks it's likely that the bills will never be paid. But I think the market thinks, hey, that's an indication that you might have to wait 2 more tenths of a year to get paid in expectation. Now, when you look at those figures, at least as of Friday's close, I haven't looked again this morning, it suggests a pretty significant chance of a default. Okay, it absolutely, the market is acting like it is, a double-digit probability. So, I mean, I'm not an expert on this kind of math, so I can't tell you whether the market thinks it's 20% likely or 40% likely. It's not 90% likely, but it's not 5% likely either. Okay, let's just say it's 20, 25% likely. It's non-trivially likely that we will default. Okay, so now the question is, why hasn't the stock market crashed? If there's, say, a 25% chance of default, and if a default would cause the stock market to go down 40%, as some people say, then the market should be down 10% on a 25% chance of a 40% loss. But the market hasn't made significant moves like that, right? So what that suggests when you look at that financial market data is that a default would not be that shocking, but that the market doesn't think a default would really be that big a deal, right? The market thinks, yeah, they'll default, everybody will yell and scream, they'll make a deal, maybe it'll be in a day, maybe it'll be in a week, maybe it'll take a whole month, but whatever it is, everybody will muddle through and it'll be okay. All right. So I'm going to pause there and get more questions. I mean, I have lots more to say, but rather than just ramble on in case, Mark, you want something specific. If not, just throw it back to me.
Well, let me just say a couple of things. The fact that the short-term treasury market is pricing in a higher risk of default than the equity markets, I'll say a couple of things. I always feel like the debt guys are smarter than the equity guys, but that's just
right. So it could be that the stock market's just dumb. That is one possibility. But remember, there's other markets besides stocks and short-term bonds, right? So there are other markets you can look at that you would think would be effective. Remember, what people say is, oh my God, repo is going to collapse, this is going to collapse. And that may all be true. I am not an expert in all those mechanics. All I'm saying is, if that stuff were true, then you would think you would see this default probability all over the financial markets. But the only place we're seeing it is in the place where it has a direct effect. So in other words, we say the direct effect is you have to wait a little longer to get paid. And the indirect effect is all the catastrophic spillovers. We're seeing it in the direct place, but we aren't seeing it in, as far as I know, any of the indirect places. And that the markets could absolutely be wrong. They may be underestimating how. Look, we've seen these things go both ways, right? We saw Y2K, which people thought might lead to massive catastrophes, and they totally underestimated it, right? And then we've seen COVID, where the market was just doing nothing. I was talking to friends about buying put options in January of 2020 because everybody knew COVID was happening. So I'd be like, oh, there's only a few dozen cases. It's no big deal, right? Obviously, we all could have, made a fortune if we bought tons of puts. So sometimes the market, people overreact to potential catastrophe that really isn't a big thing. Sometimes they underreact to things that are a big thing. And so I'm certainly not saying to you, oh, well, if the market doesn't think it's a big deal, there's no chance that there's a problem. I'm just giving you the information that the broader markets don't seem to think that, hey, default could happen, but it's not going to destroy the economy.
all right. Very well said. I just want to if I may, hit on a couple other factors, which we haven't really drilled into, but if there is a default or it unsettles even the rating agencies that are giving AAA credit ratings for U.S. government debt, there's some probability that U.S. borrowing costs are going to increase, and a good portion of our treasuries are purchased by international investors, and they don't take this lightly, I can promise you.
Right. So it could
So,
be last time when we got the downgrade, it didn't have a big effect on treasuries. And in fact, by the way, I'm sure you've seen this, Mark. Sometimes you see the opposite argument. You say, oh, if we default, treasury rates are going to fall because it's going to basically create a, push us towards recession, which makes rates drop. Right. And so it could be so there's another set of stories there too. But long run, you would certainly think if people have less faith in our bonds, that it's going to cost us more to borrow in the future. And so it does seem like even if in the short run you don't see a big move in interest rates, in the long run it's got to hurt us if we lose credit. And I think every day that this goes on, even if it doesn't end up in a default, hurts our credibility and probably at least the tune of basis points does increase our long-term borrowing costs and is costly to the nation.
and just to build on that point, for the global economic impact of a default, remember the US dollar is the reserve currency of the world. And we're able to essentially fund our deficits with impunity if you're a Republican today because of that status. And we know there's pressures internationally to have the Chinese currency renminbi to be a competitive reserve currency to the world, and certain countries are signing on to that now. So there's, I wouldn't say today, a big risk that it's replaced or would coexist with renminbi, but should we have a default, that trend could accelerate, and loss of pure reserve currency status is going to hurt our standing as a reserve currency.
Yeah, I think the reserve currency stuff is a little overstated, to be honest. I mean, like Canada's not the world's reserve currency, but it's not like their borrowing costs are way higher than ours. In other words, I don't see much evidence that our reserve currency status makes our borrowing costs lower. And I think it is true that we some seigniorage value. In other words, the fact that there's people all around the world with, a pile of $100 bills in their basement, that's essentially us borrowing from those people at 0%. It doesn't add up to a huge amount, but every little bit helps. So there's some value there. I don't really foresee a future where people are like holding stacks of, yuan notes instead of dollars in their basement, but I guess that could happen. And I guess that would cost us a tiny bit. So I think those issues are a little overstated, and I think Paul Krugman's written relatively eloquently about that. I appreciated that when he said, from the Republican perspective today. I think that was a good way of saying it because, if you look at the data, it couldn't be clearer. Like in my adult lifetime, if you say who increased spending the most, not even just, I mean, this is even more magnified if you say deficits, but taxes are sort of a separate issue. So we just say spending. We say what president increased spending the most, so of ones who've completed their term, right? Well, of course, it's Trump by a mile. And then second is George H.W. Bush by a mile. And then third is Ronald Reagan by a mile. And then fourth is George H.W. Bush. And then the two people who basically didn't increase spending per capita at all are Obama increased it a tiny bit and Clinton increased it basically on a real basis, not at all. And so, the Republicans are this party that spends a lot when they're the president. That's not because Republicans are pro spending more than Democrats. The right way to think of this is there are a lot of veto points in the system. And so if you have a Republican president with a Republican Congress, they will spend a ton because that spending helps make them popular and helps the president get reelected. And if you have a Republican president with a Democratic Congress, they'll spend a ton because the Republican president will want to spend to help get reelected. And the Democrats will say, well, as long as the priorities are tilted, as long as there's enough for all people in America, not just for, one side's people, we'll go along with that spending, right? So with a Republican president, regardless of who controls Congress, you get tons of spending. With a Democratic president, the only way you get significant spending increases are if the Democrats have, both the House and the Senate, and for the most part, they need 60 in the Senate. So that almost never happens. So as a result of just differences between the parties, without the Republicans don't need to be quote unquote the big spending party. It's just in the nature of the setup that Republican presidents spend vastly more than Democratic presidents do. And we see that repeatedly. And obviously, now the spending under Trump, part of that was COVID, and probably that would have been spent. But you could see if we'd had a Democratic president during COVID and the Republicans had controlled the House, we wouldn't have seen $5 trillion of spending packages, right? The Republicans in the House would have said we have to put in fiscal austerity. So it would have been a very different outcome, a much lower spending outcome with a Democratic president, but because of how the Republicans would have acted. So it's just sort of a subtlety there. Look, coming back to the big picture on the standoff. I honestly don't know what's going to happen. There are this set of, they use this term extraordinary measures, which basically refer to, what did the things that Robert Rubin did in the 90s when some of these issues came up. And those are now considered perfectly normal standard things to do, even though they were shocking back in the 90s. And so the question is, are there some steps that the administration can take that would be considered shocking on the day they happen, but will almost immediately be normalized and just thought of as a regular course of business? And the probably of those, the one that the administration has hinted to an interest in is application of the 14th Amendment. The 14th Amendment says something like, the validity of the United States debt shall not be questioned. And the president could interpret that as meaning, look, we have bills to pay, we have to pay our bills, and just pay the bills. And then if somebody wants to sue, and presumably somebody will, sue in court and say, no, we're not allowed to pay our bills, we have to go into default. Well, first of all, the court may rule that no, the 14th Amendment really does say that. Second of all, of course, you do have to think carefully. If you're Kevin McCarthy, do you really want to be the person saying, I say the United States government should not pay its bills? Granny, you have money in treasury bonds. Sorry, you don't get paid. You don't deserve your money. We're never going to pay you, right? And I'm suing in court so that we don't have to pay you. That's a strong position to take. Now, I do think somebody will file that suit, but I'm just saying. So that 14th Amendment is one way to go. You guys have probably heard about platinum coins and premium bonds and other things. It doesn't seem like the administration has a ton of interest in going down those paths. It seems like if they're going to keep paying, then they're either going to say, I'm obligated by the 14th Amendment to keep paying, or they might just say, we're just going to keep paying. Who's going to stop us? Kind of, right? I mean, even if the court rules against them, if they pay, is the military going to come in and stop them from paying? It's kind of a fascinating question to sort of think in the real world. How is it going to play out? But I think if I had to guess what's going to happen, I don't think they'll get to a deal by the deadline, although they certainly might, right? They might get to a deal. If they don't get to a deal, then I think what the administration will attempt to do is turn this into a government shutdown fight, right? So one of the things that's so confusing about this is there's this much more common problem where they can't agree on a budget, not the debt ceiling, it's a budget. And when they can't agree on a budget, then they're not supposed to keep paying all the FBI agents and national parks employees and contractors and military personnel and so forth. And so then the government stops those payments because there's no budget. And then what has traditionally happened is that once people started to be upset enough about these payments not happening, is that the Republicans caved and said, okay, fine, let's agree to a budget so the payments can start up again. And so my guess is that what the people inside the administration are saying is, let's keep paying the bonds, but not pay military personnel and FBI agents and national parks employees and so forth. And then hope that the outcry from the American people over the fact that these folks aren't getting paid will cause the Republicans to say, okay, fine, we'll raise the debt ceiling just like we did the past 77 times. So that's my guess. But I want to add one last thing, and then obviously anything else you want to talk about on this, Mark, but this is the last thing I wanted to make sure I said is, I have one friend who says, look, the federal, there's a solution here, which is if the government defaults, the Federal Reserve can buy these matured bonds, right? So obviously we've all heard about QE a million times, quantitative easing. What the heck does that mean? Quantitative easing is the least transparent phrase in government history. Quantitative easing means the government goes out and buys bonds, right? And traditionally it bought treasury bonds, right? And then, but it can in fact buy corporate bonds and all kinds of other securities, right? And the TARP program and so forth, they bought all these different securities. Okay, well, so suppose that the Fed says, oh, you have $1 million of bonds maturing on the 15th, Mark. Okay, well, the government's not going to pay them, but we will buy that piece of paper from you for $1 million. We'll buy your bond, right? So that's way less risky than some of the corporate bonds and other stuff that the Fed's bought over the last 20 years, right? So it's not like there's anything unreasonable about them doing that. And arguably, it sort of solves the problem. You say, well, technically it's in default, but since the Fed will buy at face value, nobody's losing anything. right? And that is essentially starts to look a lot like what would happen if the debt ceiling had been raised. And so that may be the final fallback plan is if nothing else works, then the Fed essentially does the purchasing, which again just really kind of puts us back in the situation if they've done the normal thing and raised the debt ceiling. So now my guess is there are a bunch of A, we don't know if the Fed's willing to do it, and B, even if the Fed is willing to do it, there's probably 100 little irritating negative things that are disruptive if that happens. So it'd be great if we could avoid getting there. Of course, the Fed will not say that they're going to do this because the Fed's position is Congress, go raise the debt ceiling. It's your job to work this out. Don't put it on us. But I think a lot of people suspect that if push comes to shove, the Fed might in fact step up.
Well, Randy, again, I think this subject alone could consume the entire hour of our podcast, but I'm just going to, I'll say, put a plug in this conversation for now. And I'd like to move on to, I'll just say, the failure of Silicon Valley Bank and a couple other regional banks. I either run on those banks, but more importantly, what does it mean? And I can tell you in my business, where we're investing in growth companies, Silicon Valley Bank was a really key vendor to providing capital to not only these emerging growth companies, but the venture capital firms that were sponsoring these emerging growth companies. I've seen data points suggesting that the investment this year by venture capital firms is going to collapse. It was literally today on CNBC, not that they're any kind of an authority on the subject, suggesting a 70% decline. 70% decline in venture capital investing this year. That's like falling off a cliff. But my question to you, when you look at the failure, it's a fact, and you look at what the government did to try to stabilize deposits, and essentially they have an informal guarantee, my interpretation, but I'd love to hear your explanation, a formal guarantee for 12 months on those deposits. So what happens 12 months and a day from now? And there is an important role that regional banks play in the US economy to lend to local businesses. And having this lack of a formal guarantee long term, if I'm a CFO of a company and I'm in a small regional bank and I didn't move my money out and something to that small regional bank causes a loss, I'm going to get fired. And rightly so, because you knew it. So people are going to, I think, continue to run to the large money center banks under the concept of too big to fail. But, it's definitely an ugly situation. So I'm interested to hear your perspective on this and how's it going to play out.
Yeah. So first, I want to highlight the crucial difference with all banking conversations. Everybody, anybody writing an article about this should make very clear when they're talking about liquidity and when they're talking about solvency, right? So let's recognize on the liquidity side that in any bank, if you were to get a cadre of the most influential people in the world, the most respected people in the world, so you get Warren Buffett, Alan Greenspan, Taylor Swift, and Mark Young all to go on social media and say, whatever, Green Banana Bank is going out of business, right? It's going out of business. You better get your money out fast, or that bank or you're not going to be able to get your money. That bank's dead, right? In other words, all banks, and obviously most of us have seen the old Jimmy Stewart movie, It's a Wonderful Life, and Jimmy's like, they come to the bank and they say, we want our money. Right? We don't trust you, our money. And he said, your money's not here. It's in Bill's house and Fred's house. He's saying, I took your money and I lent it out to get businesses going and to enable people to buy homes and so forth. The money's not sitting here in the vault. Only a tiny fraction of the money's here. If everybody wants their money at once, if a third of the people all want their money at once, I cannot meet those obligations, right? And that's true of basically every bank. So every bank has a liquidity problem. And we know in the case of Silicon Valley Bank, a group of people went out and started pushing the narrative that the bank was insolvent. And these were ultra connected people. Not only were they people who themselves had a lot of prestige, but the customers were people who are, in the parlance, as the kids say, very online, right? And so these were people who were all talking and tweeting and connecting and using social media apps that they have that they don't even tell me about to tell their secret Silicon Valley stuff. And the secret handshake went out to everybody. Get your money out of SVB, it's in trouble. As soon as that happens, they're in trouble, right? Now, and the only way you could hope to save it is if the government immediately announced we're protecting all deposits, right? And that didn't happen fast enough. So the money's gone and they're out of business. And so that's not an SVB specific thing, having that liquidity problem. Everybody's got that liquidity problem. So now the question is, well, why would people start a run on the bank? And the answer is, well, people could do it just to be funny. They could do it because they're agents of chaos. But let's assume rationality. Then people would be doing it because they actually think the bank might be insolvent, right? So if you think about a typical bank situation, maybe they have, it might be normal to have assets of say 100 billion and liabilities of say 80 billion, just to pick a number, or 80, let's say 85 billion. So there's a $15 billion gap there. And so if you need to give everybody their money back in an orderly, slow fashion, you can do it. But you're going to literally be selling off mortgages and business loans, and also it's going to be not something you can do in a day or a week or a month. It's going to take a while to get out of that stuff. So what's expected of banks is, well, they keep a significant chunk of their money in stuff that really is liquid, right? That they can get to quickly, so that if say 10 or 20% of the people all want their money at once, maybe they can do that, over the course of a few days, they can get liquid, but not if it's 40 or 60%, then they're out of luck. Okay, so that is the situation for any bank. So now the question is, well, was there a solvency problem at SVB? And the answer is there was, right? And where did that come from? Well, what they did was they bought lots of 30-year treasury bonds, right? Was that a crazy thing to do? I think there's an argument that it was. My colleague at HBS, Eric Stafford, wrote a paper, and the paper is subtle and thoughtful, and I'm going to brutally oversimplify it. But he sort of, in a brutally oversimplified way, said, look, if you have all these banks that are buying long-term treasury bonds that pay 3%, and then they're lending, and then they're taking in deposits at 0.5%, then that's a great spread. They're making a lot of money, but it's not a riskless spread. And bank accounting rules pretend it's riskless. The bank accounting rules say, oh, well, don't worry. We know the Treasury is going to pay us off. Let's put aside all this debt default stuff, right? We know the Treasury is going to pay us off eventually. So it's safe. Yeah, it's safe. But if interest rates go from 3 to 4, well, then all of a sudden, the value of those bonds plummet, because those are long-term assets, and they're discounted at a higher rate. And so suddenly you discover that instead of having 85 of liabilities and 100 of assets, you have 85 of liabilities and 82 of assets. And now you're not solvent. And you're pretty close to solvent, right? If everybody was patient, there's a decent chance the rates would move back the other way and you'd be okay. And even if you weren't, everybody would get 98 cents on the dollar or whatever. But that's not how it works. The way it works is that as soon as people start to worry that that's the situation we're in, they all run to get their money out, and the last guy out gets nothing because there's nothing left, right? And that's when the government has to step in. Okay, so what does the government do? The government says we'll insure deposits. Remember, deposits are already insured. They're insured up to $250,000. So then ask yourself, why does anybody have more than $250,000 in a bank? Why can't they just put money into different banks so that they're fully insured? And the answer is, well, if you're a company and you are making, payroll of tens of millions of dollars and so forth, you might have 30 million bucks in the bank. Are you really going to spread your money out among 120 different banks? That sounds like a nightmare. How are you going to make payroll from 120 different banks? So then the answer is, there are these sweeps programs, which not many people knew about, but people with that kind of money should know about, where you put your money in one bank, $30 million, and every night they spread it out among 120 banks. And every day they bring it back in to make payroll and so forth. And then you are fully protected. And of course, there's a fee associated with this, so people would prefer not to pay the fee. But beyond the fee, your bank doesn't like it. Silicon Valley Bank wants to hold your $30 million because they can lend it out to venture capitalists and to emerging entrepreneurial firms. If they send it out to 119 other banks, then they can't use it to run their venture debt business and make profits on that. So the bank is not going to treat you as well if you insist on being in this sweeps program. By the way, it's worth making a point, I may have made this with you on a previous podcast, that when it comes to little banks, people are worried about them, but they actually, if you're wondering, why do we only hear about the regional banks and not the little banks? The little banks, if anything, should be in great shape. Everybody should have woken up to the need for these sweeps programs. And if you need to put your money that's in SVB or let's say it's PNC Bank on the East Coast, you need to spread that out among 120 banks. So you could put 4 in the big too big to fail banks, right? BFA and so forth. You put 1 in the bank you're in, that's 5. You need 115 more. you're going to need to put some money in some little banks. So those little banks are probably bringing in tons of assets from these sweeps programs. So that's why they're not in a problem scenario. Okay, so now let's come to the regional banks. So should we worry about the regional banks? It makes sense to worry because it was completely normal. People act like, oh, SVB, what a bunch of idiots. Why didn't they hedge their long-term interest rate risk? I'll tell you why, because then the banking is a money-losing business, right? In other words, if you take in deposits at 1% and then you lend them back out at 1% by buying short-term treasuries or whatever, then you break even on that, but you still have to pay for all the buildings and the tellers and the electricity and the mailings. So there's no profit. You're going to be out of business because you're going to have negative profits. The way banks make money is they take in deposits at a low interest rate and then put the money out in stuff that pays more. And long-term treasuries are the safest version of that, right? Putting money into venture debt or mortgages or business loans are riskier than long-term treasuries. So anytime you see somebody saying, oh, they should have hedged their interest rate risk, that person really doesn't understand banking at all. Like that, you should just stop reading that article and note that person's name down and don't read what they have to say anymore, at least on these financial subjects. So, okay, so the point is, all the banks have this problem. Right? All the banks have the problem that they probably lost a lot of money on long-term, even mortgages, which it's more subtle. But if you lent somebody a 30-year fixed rate mortgage at 3.5%, and now interest rates are way higher, you lost a bunch of money on the value of that mortgage, and you may not have to reflect it on your books. But so it's appropriate that people are worried about the solvency of regional banks, and people need to look one by one and see which ones are in good shape, right? And then you need to figure out, okay, and then you need to look at the liquidity problem, which is there a lot of money in this bank that's in uninsured deposits of more than $250,000? And if there is, then obviously there's some concern that those people are going to pull their money out because they're scared. And then you end up with the run on the bank and so forth, right? Now, as long as you have less than $250,000 in the account, you're fine. The government's gonna take care of your deposit, so you'll be okay. But understandably, people focus on the move into JP Morgan and B of A, but there's another really big move into money market accounts, right? People are basically saying, hey, wait, the interest rate moved, the T-bill rate went from 0 to 4% or 5%. But my bank is still paying me 1%. This sucks. Why am I sitting in a bank account at 1%? And now the banker has a really tough choice, right? If the banker says, yeah, I'm going to start paying 4% on deposits, well, a lot of their profit margin just went away. But if the banker says, I'm going to keep it at 1%, then a lot of their deposits are going to go away because people are going to say, I'll either find a bank that will pay me 4%, or I'm going to put it in a money market fund where it's going to be in corporate paper and other kinds of assets that might be a little bit riskier than insured deposits, but for a way higher rate. And so there is legitimate concern about these regional banks. People do need to look at them one by one. I think there is an argument to be made that America's banking system would be safer if we didn't have so much in the way of regional banks, if we had, instead of 4 giant too big to fail banks that are very heavily regulated and are therefore viewed as pretty safe, we had 10 banks like that. Then we left out 50 or 80 regional banks in the middle, and then we had thousands of tiny banks. So then you have 10 banks you knew were safe. You'd have 1,000 tiny banks that might fail, but it's not going to be systemically problematic if they do fail. And then maybe you need to hollow out this middle. But I'm not sure about that. I read a convincing article saying that. I'd love to read an article taking the other side. All right, so I think I monologued long enough on that one, Mark. What did I leave out, or what points you want to make, or what have you?
Well, I guess the point I wanted to make, and again, you articulated the issues extremely well with the regional banks and the dilemma they're in, and that will play out over time. But let's bring it to day to day. Bridgepoint Capital works with growth companies. Yeah. And I can promise you, because I see it every day, the access to liquidity has dried up. As an example, if you're looking to secure a loan and your regional bank is under duress, they're not lending to you. So that's strike one. So you might say, well, I'll go to another one. Well, if you go to regional bank number 2 and you haven't been a long-standing client, they don't want to lend to you because they want to service the regular clients first. So call that strike 2.
Well, let me highlight your point. They need to be in liquid stuff now. They know that money is likely to flow out for all the reasons we just discussed. So they have to be liquid stuff. But a 5-year loan to a growth company is not a liquid asset. There's no way they can just get that money back quickly. So
Right.
they really can't afford, except where it's absolutely necessary for business reasons, i.e., working with a long-standing client, they really can't afford to make those kinds of loans. So, Mark, let me ask you this as a person who's in this space, because I sit on the board of a company that does venture debt. And their story was, hey, SVB has 80% of the market. There's tons of opportunity in this space. It's really great. And their timing was exquisite, which is to say they launched a month or two after. They launched last month. They launched just after SVB collapsed. So they're coming into a market where the opportunities are incredible because so many people need money and there's nobody to give it to them because the big dog is gone, right? So if people are interested in that, reach out to me and I'll put you in touch with these guys. I think they're very smart in this space. But here's what I don't understand, Mark. They told me that the typical venture debt deal worked like this. Company goes out and raises venture capital. They raise, say, 100 million of venture capital in a Series C or whatever it might be. And then they follow it up with 15 or 20 million of venture debt just to kind of goose it a little, get a little extra capital, right?
Yeah.
And so in other words, so tell me about the kinds of loans you've been seeing that have dried up because SVB is gone, because that kind of loan doesn't seem like a crisis, right? Because A, if you just got 100, yeah, it would be nice to get the extra 15 or 20, but it's not the end of the world. And B, a lot fewer of those $100 million checks are getting written, as you mentioned earlier. So you wouldn't think it would be such a big deal that SVB isn't writing the follow-on checks. So it sounds like you're talking about a different kind of growth equity loan that SVB was doing that's gone away. So tell us that story.
Okay, I do want to come back to the growth equity loans because there's a little more to that story as well. But I'll just say in the last 30 days, we've seen significant inbound inquiry for us to help our clients and our network source debt financing for all the reasons I described. They basically are being denied by their existing lender for reasons we've already articulated. So it just so happens I'm not a kid. Randy, you're not a kid either. So we've been in the markets for a long time. We have networks. So in the case of Bridgepoint, we have several networks, including large banks, regional banks, the smaller banks. We literally have the ability to tap both the public credit markets and, importantly, the private credit markets. Because the fact is, private credit today is roughly 10% of the lending in the US, 10%. And regional banks and smaller banks are about 40%. So they're the sector of the market that's being squeezed, and the private credit market is expanding. So they're trying to fill the gap. So Bridgepoint at the moment has two live deals. One of them is for a large family office that essentially is headquartered in Puerto Rico that seeks a $70 million loan, up to 70, to finance a logistics company that they own outright with no debt on the books that last year had 50 million of EBITDA. So in a normal lending environment, getting a 1 or 2x EBITDA on a business is not a stretch. Today it is. It's more difficult than it should be to source that capital, but we're doing it. Another deal we have is more of a traditional Silicon Valley bank like financing, but it's an asset-based loan that essentially wants to do two things: swap out some existing senior debt and overlay a new senior debt facility at 4x the previous amount as the business continues to grow. So they need a lender to keep pace with their growth. So that's just two examples, literally in the last 30 days, that have been inbound to us. So,
Yeah.
you know, I'll just say 2 data points starts to be a trend. And it's clear there is a trend here, that there's a need to fill the credit shortage that exists. And my experience after many years is I call banks lemmings. So basically they all overlend, and when it's times are bad, they all underlend. The irony is when there's underlending, that's when you should be lending, because that's when you get the best deals, the best terms. They don't
That's right.
act.
No, it's a very attractive time. So on the one hand, if you're Bridgepoint, if you're a company that needs capital and you're finding that your regional bank, who normally would have lent you money, isn't able to do so, or maybe you're in that Silicon Valley world where you come to SVB, you should be calling up you and Bridgepoint to see about that. And then at the same time, it sounds like for people who are going to back those kinds of loans, like this fund that I'm close with, or like the people you work with at Bridgepoint, could be a really juicy time to be putting money out on get higher quality companies than you normally get on better terms than you normally get, and so that's exciting.
It is, and that's exactly what we're doing. I don't want to beat a dead horse on this issue, but suffice it to say that Bridgepoint seeks to partner with our clients. That's been our model. And this is an example of us expanding the scope of our services to meet a current need. So we're doing that successfully and we'll continue to do it. I just want to say one final thing, and then I'm going to move on to topic number 4, which we do have a few minutes. So Randy, get ready to talk about the 4th subject. We have these platforms and these relationships that are very long-term in nature that have been successful. But just as an example, we have one platform that has close to 2,000, and I'll repeat that, 2,000 lenders, both public and private credit offerings. So it's hard for me to imagine if someone has a debt financing requirement that we can't meet it. So between that platform, between the networks that we have today and other people we work with, et cetera, we are very, I'll just say, thorough in our ability to access that capital. So I don't want to say anything more about it, but just so it's out there, that's a service we provide, and I think it's very timely, and I think we can help people. But now, Randy, if I may, let's go on to this mythical 4th topic. I'm going to let you unveil it, but we were discussing this prior to the call today.
Yeah, well, we were talking about demographics, population, fertility, and related subjects, and it's an absolutely fascinating subject. You and I, Mark, are from the generation who grew up worried about overpopulation, and those concerns are still real. Obviously, sometimes I'll hear young people say, "Oh my gosh, people shouldn't have children because the more people there are, the more energy they'll burn, the more climate change we're going to have, and climate change is an existential risk." And that concern is worth thinking about. At the same time, if you don't replace your population, that can be highly problematic from a number of perspectives. And one way of looking at it is from you might say the baby boom retirement perspective. In other words, if you have a large cohort of people and then they are in their retirement years, so they're not producing but they're still consuming, and then you have a very small cohort of young people because their children didn't have many children, then what you have is a small cohort of young people paying for not only their own lives, but also the lives of the retirees, right? And that can be very, very stressful. It could be, just economically challenging, maybe even to the breaking point where people say, oh my gosh, we can't afford to give retirees the kind of lifestyle we thought we could because there's just not enough people working and producing to do that. So that's one set of concerns. And a friend just sent me a piece many of you may have seen that Stanley Druckenmiller gave as a speech and was published, sort of emphasizing this issue. Okay, now, and just to give you an idea how extreme this is. So replacement fertility is 2.1 children per woman. Okay, so in other words, you might think it would be 2. So you have 1 boy and 1 girl, and it needs to be 2.1 because unfortunately, some people don't survive to childbearing age, so you need to have a few extra births to make the break even, right? So if you want to keep the population steady, you need to be at 2.1. And then let me note that the United States has had a growing population, basically, virtually nonstop since its founding. And there is a lot to be said for that, right? Because what that means is there are lots of young people at any given time to pay for the given group of retirees. And by having more people come to an area, people buy a home and then the value of their home goes up because there's more people who want to live there and are, fighting for the right to buy that house and so forth. And so there's a lot of benefits that come from a growing population. Okay. But you need 2.1 to break even. Now, current fertility in the United States is 1.8. So that's quite a bit below 2.1. Now, you can make up for that if you allow enough immigration. I don't think the current immigration levels are sufficient to keep population steady, let alone growing, but it might get us close. And so that's one thing to think about in terms of the immigration issue. But just to give you an idea how severe this sort of thing can be, I just read the other day, and if somebody knows this statistic is misleading or wrong, feel free to let me know, but it's consistent with other things I've read, that in South Korea, the fertility rate per woman is 0.8. Okay, so 0.8 versus 2.1. So you can see that is somewhere between a half and a third. Let's call it about 40% of it's less than 40% of the total replacement rate. So you could have an absolutely plummeting population. South Korea is not a place that historically has taken in tons of immigrants. They have a very strong culture, and I think they worry that if too many outsiders come in, it's going to change the nature of that culture. But then you say to yourself, my gosh, how are you going to deal with how's that economy going to work when there's such a tiny number of people in their 20s and 30s and all these older people? So that's an issue. Now again, globally, population is still increasing steadily, and most of that population increase is happening in Africa. And so, of course, one possibility is that there's lots of emigration from Africa to other parts of the world where the population is slow. But again, we know people can be very resistant to immigration, and for various reasons, some good and some not so good. So that is a complexity. Now, here's another issue to think about. And again, I think probably people from maybe people from different parts of the world are watching this, but let's just for a moment take a purely American perspective. I can say, having grown up here, that many Americans, I'm going to say probably a heavy majority of Americans, although I could be wrong, take quite a lot of pleasure in America's role as world leader. And we were one of the world leaders, and then maybe there was a period they called the unipolar world where America was the world leader. Now maybe China is joining America on the stage as a fellow world leader. And the question is, what enables you to be a world leader? And this is the kind of thing an economist would say that causes people to think we oversimplify the world. I recognize all the nuance and complexity of the world, but still, if you said total GDP, not GDP per capita, but total GDP gives you, I mean, Luxembourg has higher GDP per capita than the United States, but they're not the world leader, right? It's total GDP that enables you to field an army, have weapons, have economic soft power, be a big player in trade as both buyer and seller, et cetera, et cetera. So if we say total GDP is a pretty good metric for how big, for how important a country is in the world, well, as you know, depending on how you measure it, China is either past the United States or approaching the United States or what have you. China has, about 4 times the population of the United States. So if the United States wants to be, let's say, on a level playing field with China, what are the options? Well, one would be to have 4 times the GDP per capita of China. Well, that was true historically, but it seems pretty obvious that that's just not going to be true in the future, that there's going to be convergence. It's not to say the United States won't still be ahead in 20 or 30 years. It may not be, but it's not going to be ahead by a factor of 4. Okay, so then the question, although let me just add, China, because the one-child policy has its own complexities with demographic issues. And so one Chinese person told me they refer to it as the 4 grandparents policy, right? That each kid has 4 grandparents that they're responsible for. So there are issues there too, right? And that people may be underestimating these demographic things because they move so slowly. They tend to be underestimated, but boy, they are, what is the phrase, the wheels grind slow, but they grind exceedingly fine. The wheels of demographics grind exceedingly fine. And so that's something to think about. But so Matthew Iglesias, who's a writer, a journalist, whose work I think is consistently interesting, he put out a book last year called 1 Billion Americans, in which he argued, look, if the United States wants to be the world leader, the only way for that to happen realistically, for the United States to still be a top world leader in 50 years, not necessarily to stand alone, but to be among the very top tier world, is for its population to grow massively, right? And how could you make that happen? Well, again, you either need to take in a lot of immigrants, or you need to have pronatal policies. That is to say, encourage people to have more children, which can be as simple as things like, providing funded daycare or giving people paid time off from work or what have you. But in general, those policies have had modest effects historically. It turns out it's not that easy to get people to have a lot more children. And, what we've seen in recent decades is, I think it's not too far off the mark. If you've read Jane Austen's books, and she says, her books are very clear. In Regency England, a woman who wanted to survive and not starve had to get married and have children. Right, that was the ticket. Right, is you could get, you could have your life, expenses handled because women weren't allowed to really have careers, with the rarest of exceptions. They weren't allowed to have careers. And so the women had to marry somebody. And then, of course, children were part of the deal of that marriage. That was part of what they write. Okay, fine. So we had this horrible sexist system that forced women into marriage and childbearing. And in that system, we saw that women had a certain amount of children. So, well, we don't have that system anymore, and thank goodness, because it was evil. But what we have now is a situation where women can figure out for themselves what an appropriate amount of children to have is. And some of them decide that the right number is two, and some of them decide that it's three or four, and some of them decide that it's one or zero. And so the second amazing fact, besides the 0.8 from South Korea, the other stat that blew me away from America is that, in the 70s, when Mark and I were young, 40% of families had four or more children. And now that number is, I think, less than 10%. Right. So it was really normal to have four or more kids, and now it's not anymore. And again, I'm not blaming anybody for this. Right. I'm just saying this is what it shouldn't surprise us that with the changes that have happened with careers being available to everybody, that fewer people say, yeah, I want to have 4, 5, 6 kids. But with that and all the other changes, what we're seeing is the potential for shrinking population here and in a lot of other developed countries. And I don't think people have fully thought through the consequences of those changes. And I don't have all the answers, as you can tell. I have more questions than answers, but just thought it was something people might want to start thinking about.
Well, I'll just share as a concluding thought here. 2 sessions ago, when we were on, you mentioned the Ozempic phenomenon, if you will, as a way for people to lose weight. And clearly that's an exploding product, and it's done pretty much what you articulated it would do. And secondly, we had the Chat GPT phenomenon that occurred, or we announced it a short while ago, but again, that's exploded as well. And that has lots of impacts that we articulated last time. And now you're bringing up, I'll just say, the declining populations. I think there's some other factors, and we're not going to get into them today, that we can discuss next time about, I'll say, intimacy, the way people on a go-forward basis will deal with relationships, et cetera. But again, let's wrap it up here. We hit the hour-long mark. And Randy, I just want to thank you so much again. I thought your insights were extremely valuable and helpful. And everybody, thank you for listening, and we'll look forward to the next time. So have a great day, everybody. Bye-bye.
Thanks, Aaron.